Most people imagine income like an elevator. Make more money, move up a floor, and every problem gets smaller. But in America, income often works more like a video game. Every time you level up, the map gets bigger, the enemies get more expensive, and somehow your bank account still ends the month gasping for air. At $1,000 a month, the problem is survival. At $6,000, it is stability. At $15,000, it is lifestyle. And at $50,000, the real question is no longer what you can buy. It is whether you can finally buy back your time. Hey friends, Hazel here. Today, we are following one American household through 5 different income levels, from $1,000 a month to $50,000. To keep the comparison honest, every number in this video means monthly household income before taxes. Your real life will look different depending on where you live, whether you have children, and how much debt you carry. Because a 6-figure income in rural Ohio is not the same life as a 6-figure income in Manhattan. And as you are about to see, a bigger paycheck can solve a money problem while quietly creating a much more expensive one. Part 1. 1K to 3K a month, Survival Mode. Imagine getting paid on Friday and watching most of that money disappear before Monday. Rent is due. The phone bill is late. The car needs gas. The refrigerator is almost empty. At $1,000 to $3,000 a month before taxes, you are not building a financial future. You are negotiating with the present. Every dollar already has a job before it arrives. Housing is usually the first wall you hit. The federal benchmark considers a household cost burdened when housing and utilities consume more than 30% of income, and severely burdened when they consume more than HALF. At this level, 30% may not buy any realistic housing at all. Unless you share rent, live with family, receive assistance, or live in a very low-cost area, housing can swallow half the paycheck before food even enters the conversation. That creates a cruel trade-off. Cheaper housing may mean a longer commute. A longer commute means more gas, more repairs, or another bus transfer. The money saved on rent leaks out through transportation. Food becomes a calculation instead of a pleasure. You compare prices by the ounce. You choose the generic brand. You put one item back at the register because the total climbed $3 higher than expected. And no, the occasional coffee is not what keeps a household poor. The real problem is that the gap between income and unavoidable expenses is simply too small. There is no margin. That is why an emergency at this level is rarely just an emergency. It becomes debt. Bankrate reported in 2026 that only 30% of Americans would pay a $1,000 emergency directly from savings. For a household near the bottom of this income range, a $1,000 repair can represent an entire month of income. A flat tire can mean missing a shift. Missing a shift can mean a smaller paycheck. A smaller paycheck can mean a late fee. Then the late fee makes next month harder. This is how one problem recruits 3 more. And poverty comes with its own hidden surcharge. You cannot buy groceries in bulk, so each unit costs more. You postpone preventative maintenance, so a small repair becomes a large one. You carry a credit card balance, so yesterday's groceries are still charging interest next month. Even your attention is taxed. Part of your brain is always running numbers in the background. Can this bill wait? How many miles are left in the tank? What happens if the child gets sick? Can $27 survive until Thursday? At this level, wealth-building advice can sound almost insulting. You cannot optimize an investment portfolio when the electric bill is competing with dinner. The first meaningful upgrade is not a nicer car or a better apartment. It is margin, enough space between income and expenses for one bad day to remain just one bad day. Part 2. 4K to 8K a month, the middle class squeeze. Now the household income rises to somewhere between $4,000 and $8,000 a month before taxes. Life becomes visibly better. The refrigerator stays full. The utility bill is paid automatically. A dinner with friends no longer requires a 3-day internal investigation. You may finally have health insurance through work, a reliable used car, and an apartment where the washing machine is not shared with 14 strangers. This level is where survival anxiety begins to fade. But it is also where financial autopilot becomes dangerous. The raise does not arrive alone. It brings a parade of reasonable upgrades. The old car is unreliable, so you finance a newer one. The apartment is too small, so you add another bedroom. Your job requires better clothes. Your friends can afford weekend trips. Your streaming services multiply like they are paying rent. None of these decisions feels reckless by itself. That is exactly why lifestyle creep is so effective. Experian reported that the average new car payment reached roughly $770 a month in early 2026, while the average used car payment was more than $500. Add insurance, fuel, registration, parking, and repairs, and one normal car can consume a four-figure amount every month. Then student loans return. Childcare enters the picture. Takeout becomes the price of having no energy after work. The household earns more, but the fixed monthly obligations grow faster than the emergency fund. This is the middle-class squeeze. You are no longer obviously poor, but you are still financially fragile. Your lifestyle looks stable because the monthly payments are current. But that stability disappears surprisingly fast if the paychecks stop. The key difference between this level and survival mode is that you finally have choices. But every upgrade converts a choice into a bill. A larger apartment becomes 12 months of higher rent. A new car becomes 6 years of payments. A vacation becomes a credit card balance that follows you home. This is where income and wealth begin to separate. Income is the money moving through your life. Wealth is the part that stays, compounds, and eventually works without you. If every raise is immediately converted into a better lifestyle, your income rises while your freedom remains exactly where it was. You may have escaped the cheapest treadmill, but you certainly did not escape the treadmill. Part 3. 8K to 1K a month, the six-figure crossroads. At roughly $8,300 a month, household income crosses $100,000 a year before taxes. This is the number Americans have been trained to treat like a finish line. But a six-figure income is not one lifestyle. It can mean comfort in a low-cost city, pressure in a high-cost city, or constant negotiation for a family paying for childcare, healthcare, housing, and debt at the same time. At this level, the household can finally make serious progress. There may be enough room to build an emergency fund, contribute to a retirement plan, pay extra toward debt, and invest every month. But there is also enough income to qualify for a much more expensive life. The bank approves a larger mortgage. The dealership approves the luxury SUV. The credit card company raises the limit. Every institution suddenly becomes very supportive of your dream to owe them more money. This is the six-figure crossroads. One household keeps its previous lifestyle for a few more years and directs the raises into assets. Another household upgrades everything at once. From the outside, the second household looks richer. Inside the balance sheet, the first one is quietly winning. The trap is not avocado toast or one nice vacation. The trap is permanent overhead. A one-time purchase hurts once. A larger mortgage, to car payments, private school, premium insurance, and recurring memberships require the high income to continue every month. The more your lifestyle depends on your next paycheck, the less wealthy that paycheck actually makes you. At this level, one ratio matters more than the salary itself: how much of the income becomes optional capital after taxes and essential expenses. If the answer is almost nothing, the household is earning six figures, but operating with a $0 margin. If the answer is 10, 20, or 30%, the household has finally started converting labor into freedom. Part 4. 12K to 5K a month, high income, high stakes. Now household income climbs to $12,000, $15,000, even $25,000 a month before taxes. The obvious problems get easier. A car repair is annoying, not catastrophic. A flight can be booked without waiting for payday. The grocery bill no longer controls the mood of the entire week. But the financial game changes again. At this level, people often stop comparing themselves with the average household. They compare themselves with colleagues, clients, neighbors, and social circles earning just as much or more. The definition of normal becomes dangerously expensive. The reliable car becomes a luxury lease. The comfortable house becomes the house in the right school district. The occasional vacation becomes an international tradition. Convenience becomes a recurring expense because the job creating the income also consumes most of the household's time. Now the household is not only buying products. It is buying relief from a high-pressure life. Meal delivery saves an hour. A cleaner saves a Saturday. Premium travel makes a short vacation tolerable. Childcare keeps to demanding careers running. Some of these expenses are rational. The problem appears when every solution is financed by the assumption that the income can never fall. This creates a golden cage. The household may own a beautiful home, drive expensive cars, and still feel unable to leave a toxic job. The salary is enormous, but so is the burn rate. And the higher the income, the more dramatic the fall can be. Losing a job does not just threaten the basics. It threatens the entire identity built around being successful. At this level, the difference between rich and fragile is not visible from the street. It is visible in liquidity, debt, diversification, and the number of months the household could live without selling its time. The goal is no longer simply to earn more. The goal is to stop allowing every new dollar to create a new obligation. Part 5. 30K to 50K a month, from income to ownership. At $30,000 to $50,000 a month before taxes, the household earns between $360,000 and $600,000 a year. This is an extraordinary income, but it still does not automatically create wealth. A surgeon with a massive mortgage, expensive habits, and no investments can remain dependent on their next month of work. A business owner earning less, but owning valuable equity may have far more freedom. This is the level where the central question changes. It is no longer, what can I afford? It becomes, what can I own that keeps producing value when I stop working? There is a practical limit to how much better groceries can become. There are only so many cars one household can drive, and only so many bedrooms it can use. Once consumption stops scaling naturally, a large surplus can finally emerge. That surplus can disappear into status, or it can be converted into ownership. Ownership may mean diversified investments, retirement accounts, real estate that makes economic sense, or equity in a business. The specific asset matters less than the transition. Money is no longer used only to upgrade the present. It is used to reduce dependence on future labor. This is also where tax planning, risk management, insurance, and diversification become more important. High income creates opportunity, but concentration can still destroy it. One company, one client, one stock, or one booming industry can produce a fortune and then quickly wipe it out. True financial security comes from making the household harder to break. The greatest luxury at this level is not flying first class or buying a larger house. It is optionality. You can leave a bad job without immediately endangering your family. You can take time away. You can help a parent. You can survive a market downturn without selling everything in a panic. But even $50,000 a month cannot purchase discipline. If spending expands without limit, anxiety simply moves into a more expensive home. So what actually changes across every income level? At $1,000 a month, money buys survival. At $5,000, it buys stability. At $10,000, it creates choices. At $20,000, it tests your restraint. And at $50,000, it gives you the raw material to buy back your time. But income alone is never the final level. The real progression is margin, then savings, then ownership, and finally freedom. A person can earn more and still move backward if every raise becomes just another payment. And another person can earn less, keep more, invest consistently, and quietly build a life that no longer collapses when one paycheck disappears. The richest-looking household is not always the wealthiest. Sometimes it is simply the household with the most expensive obligations. So if your income increased tomorrow, what would you upgrade first? Your lifestyle, your assets, or your freedom? Tell me in the comments and subscribe for more animated stories about money, work, and the financial decisions shaping life in America.